Hey everyone, it's Finance Flix Hub, and you're watching Finance Flix Hub. Today, we're digging into a tax proposal that, if passed, could shake up how foreign investors interact with U.S. markets. It's buried deep in a massive piece of legislation. But if you're from countries like Canada, the UK, Japan, or Australia, you need to know what's going on. The proposal is called Section 899, and it has the potential to raise a lot of money for the U.S., but it could also backfire. Let's break it down. So what exactly is Section 899? It's a provision in the Tax Relief for American Families and Workers Act of 2024, which passed the U.S. House of Representatives back in May. The bill itself covers a ton of ground: child tax credits, business deductions, research incentives. But tucked into the fine print is this new idea to impose surtaxes on investors from certain foreign countries. Which countries? Well, ones that the U.S. sees as taxing American companies unfairly. Think of digital services taxes, global minimum tax rules, or extra fees on American tech firms. If your country is on that list and you're earning investment income from U.S. sources, then Uncle Sam wants a bigger cut from you. Here's how it works. Normally, if you're a foreign investor, let's say a retiree in Canada or a company in the UK, and you invest in U.S. stocks or bonds, your income might be subject to withholding taxes. But those rates are often reduced through tax treaties between your country and the U.S. Section 899 basically overrides those treaties for certain countries. It imposes a new surtax, starting at 5% and increasing by 5 percentage points every year, up to a cap of 20%. And this surtax is added on top of the normal withholding rate. So if your tax treaty says your dividend income from U.S. stocks should be taxed at 15% in year 1, you'd pay 15% plus 5% equals 20%. In year 2, it jumps to 25%. Year 3, 30%. And eventually, you could be paying up to 35% in total taxes on that income. That's a serious bite out of your returns. The tax applies pretty broadly. We're not just talking about individuals here. Section 899 targets foreign corporations, partnerships, trusts, pension funds, even sovereign wealth funds, like the Canada Pension Plan or Norway's massive oil fund. So whether you're a big institutional investor or just a retiree holding some U.S. dividend stocks, you could be affected if your country is on the list.
Yes, there are a few exemptions. Some types of income won't be hit by this surtax: portfolio interest from things like corporate or government bonds that's exempt under current rules, bank deposit interest, certain mutual fund dividends, and income earned through qualified foreign retirement plans. But the wording in the bill is still a bit vague, and there's concern that even those might be affected depending on how the rules are finalized. For example, there's uncertainty about whether treasury bonds could fall under the surtax in some situations. That could have huge implications, especially given how much U.S. debt is held by foreign investors. So why is the U.S. doing this? The main reason is retaliation. Countries like Canada and the UK have started taxing large U.S. companies, especially in the tech sector, using things like digital services taxes. Others are signing on to OECD rules that introduce minimum global tax rates that impact how American multinationals are taxed overseas. Section 899 is the U.S. pushing back, saying, if you tax our companies unfairly, we'll tax your investors. And there's a financial motive, too. The Joint Committee on Taxation estimates Section 899 could raise over $100 billion over 10 years. That's a pretty big number, especially when you're trying to fund tax credits and budget programs elsewhere in the bill. Here's the issue: these estimates assume that foreign investors won't change how they invest. And that's optimistic. Let's say you're a Canadian retiree who holds U.S. dividend-paying stocks in your portfolio, rights, utilities, whatever. Right now, you might pay 15% withholding tax and live with that. But once that tax jumps to 25% or 30%, that investment starts to look a lot less attractive. Your after-tax yield drops, which means your income drops. And that might push you to sell and reinvest in Canadian stocks or other international assets. If enough people do that, it could cause capital outflows from the U.S., meaning less money coming in to support American businesses and the U.S. government's debt. There's also the risk of retaliation. If the U.S. goes after foreign investors, other countries might respond by tightening the screws on American investors abroad, or U.S. companies doing business overseas. It could lead to a kind of mini trade war, not in goods, but in investment capital. And that's not something you want in a global economy already dealing with inflation, rising interest rates, and fragile supply chains. That's why a bunch of global corporations, including Toyota, Shell, and LVMH, have already started lobbying against this. They don't want to see the US become a less attractive place for foreign capital.
Now let's be clear, Section 899 is not law yet. Yes, the House passed the bill, but the Senate still needs to approve it. And given how contentious some parts of this bill are, it's far from guaranteed. Some folks believe this surtax isn't even meant to be permanent. Instead, it's a bargaining chip, a way to pressure other countries into backing off their taxes on US companies. If they back down, the US could drop Section 899 and call it a win. But if things escalate, foreign investors could find themselves paying a lot more tax on their US income. If you're a US-based investor, this won't impact you directly, but it might affect market demand, especially in bonds and dividend-heavy sectors like utilities and real estate. If you're an investor based outside the US, now is the time to review your exposure to US assets, especially those that generate dividends or interest. Consider switching to investments focused more on capital gains, which generally aren't subject to withholding tax. Keep an eye on how the Senate handles this bill, because if it passes, your tax bill could go up. Section 899 is just one line in a 200-plus page bill, but it could have major consequences for global capital flows. The US wants to protect its companies from what it sees as unfair tax treatment, but by doing so, it might be making the US a less attractive place to invest for people and institutions around the world. So whether you're in Toronto, London, or Sydney, or even in New York watching how this plays out, this is a policy worth watching. If you found this helpful, hit like, drop a comment with your thoughts, and subscribe so you don't miss future updates. I'll keep covering it as this moves through the Senate. Thanks for watching The Plain Bagel. See you next time, and make sure you subscribe our channel.